A significant shift is underway in North American commerce that deserves careful attention from every American business owner. Canada, which has been our largest trading partner for nearly 3 decades, is systematically restructuring its economic relationships in ways that could reshape the continental marketplace for years to come. Prime Minister Mark Carney recently unveiled what trade analysts are characterizing as the most ambitious transformation of Canadian trade policy in modern history. His administration has committed to doubling exports to non-U.S. markets within 10 years, and the implementation is already producing measurable results. The implications for American industries are becoming increasingly evident. Tourism revenues have declined by $5.7 billion. Manufacturing supply chains face disruptions. Recent data indicates that Canada has successfully redirected approximately 25 to 30% of traditionally U.S.-bound exports toward European and Asian markets. This analysis examines 3 critical dimensions: the mechanisms behind Canada's trade diversification initiative, the American industries currently experiencing revenue impacts, and the potential long-term consequences for the U.S. economy. The numbers behind the strategy. Prime Minister Carney's recent parliamentary address outlined Canada's intention to double non-U.S. exports over the coming decade. This announcement was followed by immediate action, with the government mobilizing what officials describe as a comprehensive trade diversification initiative involving multiple cabinet ministers, conducting missions to Europe, the Middle East, and Asia to establish new commercial partnerships. The current landscape reveals important context. Canada presently directs 76% of its exports, valued at approximately $430 billion annually, to the United States. This bilateral relationship, worth $1.3 trillion, supports roughly 2 million jobs across both nations. However, recent months have shown Canadian exports to the U.S. declining by 3% year over year. During the same period, Canadian exports to the United Kingdom increased by $9.7 billion. European Union-bound exports rose by $5 billion, representing a 20% increase. Exports to China grew by $1.57 billion, with crude oil shipments to China surging 240% following the Trans Mountain Pipeline expansion. International Trade Minister Maninder Sidhu recently stated that comprehensive trade diversification efforts are underway, acknowledging that Canada recognizes its overexposure to U.S. markets and the necessity of expanding into alternative destinations. The catalyst involves escalating tariff measures from the Trump administration, with duties reaching 35% on various Canadian goods and 50% on steel and aluminum. Canada responded with matching retaliatory tariffs on $20.7 billion worth of U.S. imports. Rather than waiting for economic pressure to force concessions, Ottawa began constructing pathways to reduce dependency on American markets. Canadian oil exports to destinations outside the United States recently reached record levels at 525,000 barrels daily. Petroleum that historically flowed exclusively to American refineries now serving Asian customers. New infrastructure and commercial relationships are being established while certain American industries begin experiencing constraints. Execution strategy and mechanisms. Canada's approach leverages existing frameworks rather than building entirely new structures. The nation maintains 15 free trade agreements covering 51 countries, providing access to 61% of global GDP and 1.5 billion consumers. The Carney administration is maximizing previously underutilized trade infrastructure. The European Union represents the most immediate opportunity. The comprehensive economic and trade agreement between Canada and the EU has been provisionally enforced for years, but remains underutilized. Currently, only 4% of Canadian exports reach Europe, compared to 70% flowing to the United States. Government officials view this as readily accessible expansion potential. Recent developments include substantial increases in Canadian crude oil exports to Europe as U.S. market profitability declined under tariff pressure. Aluminum shipments to Europe surged as producers sought alternative buyers. Canola seed exports to Europe increased more than tenfold after China imposed 100% tariffs on this agricultural commodity. The Asia-Pacific strategy presents even more significant opportunities. Despite years of diplomatic tension, including the detention of Canadian citizens by Chinese authorities and accusations regarding India's involvement in events on Canadian soil. Carney has scheduled personal meetings with Chinese President Xi Jinping and Indian Prime Minister Narendra Modi. The economic rationale is compelling. China represents the world's largest energy importer, and the Trans Mountain Pipeline expansion provides Canada with infrastructure to deliver heavy crude directly to Asian markets. Canadian crude oil exports to China jumped 240% in recent quarters compared to the previous year. For decades, Canadian oil producers operated within a constrained market relationship with American refineries. They possessed a product but depended on a single customer with specialized heavy crude processing capabilities. The Trans Mountain Pipeline effectively created access to entirely different markets, fundamentally altering negotiating dynamics. Indonesia represents another strategic focus. A recently signed free trade agreement, currently before the House of Commons, is projected to increase Canada's annual exports to Indonesia by $216 million once fully implemented. Recent Canadian merchandise exports to Indonesia already grew by $530 million, with significant contributions from coal and potassium chloride for agricultural fertilizers. Singapore offers valuable gateway potential. Canadian exports to Singapore increased 67% recently, driven by crude oil and aerospace sector growth. Singapore operates as a global aviation hub where Bombardier maintains substantial aircraft maintenance operations, contributing to increased turbojet parts exports. Defense spending factors into the equation as well. Canada is committed to NATO's target of allocating 5% of GDP to defense, the highest military investment level in over 7 decades. This commitment opens channels for defense industry exports to European markets, particularly after Canada eased export policies for dual-use goods and joined the European Union Security Action for Europe program as the first non-EU participant. The Gulf states represent another priority, with multiple Canadian cabinet ministers scheduling separate missions to the United Arab Emirates. The Middle East offers opportunities in energy technology, mining equipment, and infrastructure development. Regarding timeline, recent analysis indicates Canada has successfully redirected approximately 25 to 30% of U.S.-bound exports to alternative markets, meaning 70 to 75% still depends on American customers. This transformation is gradual rather than immediate. However, the trend trajectory is unmistakable. Exports to Europe are up 22% recently, Africa saw an 18% increase, and Central and South America recorded an 11% boost. Unlike temporary trade disputes resolved within months, Canada is constructing permanent infrastructure, pipelines, port facilities, diplomatic relationships, and free trade agreements that will persist beyond any single political administration. Rather than waiting for policy shifts in Washington, Canada is building commercial pathways that bypass American dependency entirely. American industry is experiencing impact. The tourism sector shows immediate, measurable effects. Canadian visitors historically represented 28% of all foreign tourists to the United States, contributing $20.5 billion annually and supporting approximately 140,000 American jobs. Recent months saw passenger vehicle crossings at the U.S.-Canada border decline nearly 20% year over year. Air travel from Canada to the U.S. dropped 22%, marking 10 consecutive months of declining Canadian travel to the United States. The U.S. Travel Association forecasts a 32% decline in international tourism spending, a $5.7 billion loss compared to the previous year. Florida has experienced particularly significant impacts, with airline bookings from Canada declining dramatically. Some border states report tourism declines as large as 27%. Small hotel operators in Montana, Michigan, and Maine, states heavily dependent on Canadian tourists, report unprecedented vacancy rates. One Northern Maine hotel owner noted his typically sold-out winter season now shows 40% availability, representing an existential threat to small businesses operating on narrow margins. Manufacturing disruptions run deeper. American auto manufacturers build supply chains assuming seamless integration with Canadian part suppliers, but Canada's retaliatory tariffs, including 25% levies on non-USMCA-compliant vehicles, are forcing difficult adjustments. The furniture and cabinet manufacturing industry faces particularly severe challenges. Despite paused tariff increases, U.S. tariffs on Canadian kitchen cabinets remain substantial, prompting Canadian manufacturers who previously exported extensively to U.S. markets to seek European and Asian buyers instead. Energy security concerns are emerging. The United States currently imports approximately 63% of its crude oil from Canada, about 4.8 billion barrels annually, up from 38% a decade earlier. Much of this is heavy crude oil feeding specialized refineries in the Midwest and Gulf Coast. Canadian crude oil exports outside the United States recently hit record levels at 525,000 barrels daily, with China emerging as a major buyer following the Trans Mountain Pipeline expansion. American refineries designed specifically to process Canadian heavy crude could face supply constraints if this trend accelerates. Energy analysts note U.S. refineries have invested billions in equipment tailored to Canadian heavy oil specifications, making substitution with Venezuelan or Middle Eastern crude operationally challenging and costly. American agricultural exporters experience similar pressures. Canadian retaliatory tariffs have targeted U.S. consumer goods and agricultural products. Recent data shows U.S. spirits exports to Canada plummeted 85% in recent quarters, dropping below $10 million. Canadian consumers actively participate in Buy Canadian campaigns, consciously choosing domestic products over American imports, representing not merely tariff impacts, but fundamental shifts in consumer behavior driven by national sentiment. Trade expert David Neens observes that while Canada has successfully redirected approximately 25 to 30% of U.S.-bound exports to other global partners, they've offset only about a quarter to a third of lost U.S. export volume through alternative markets. However, he notes Canada is pursuing a long-term strategy, anticipating that U.S. economic impacts will eventually influence policy calculations, expert perspectives, and future implications. The Peterson Institute for International Economics estimates that 25% tariffs would reduce Canada's GDP by 1.2% over 5 years. However, Canada's diversification strategy is mitigating those losses faster than initially projected, while U.S. industries experience compounding disruptions over time. International Trade Minister Maninder Sidhu stated publicly that other countries demonstrate willingness to view Canada as a reliable, stable trading partner, suggesting that Trump administration policies have influenced Ottawa's strategy more than any fundamental trade philosophy differences. This represents diplomatic phrasing for a more direct observation. American policy unpredictability has made Canadian dependency on U.S. markets untenable, and other nations are eager to establish stronger commercial ties. Foreign Affairs Minister Anita Anand noted that current economic stress reflects broader shifts in the global trading system, with traditional multilateralism evolving toward multipolarity. Canada will not adopt passive approaches, hoping problems resolve independently. The political landscape presents complexity. President Trump recently indicated Canada could face ongoing tariffs without negotiation, signaling limited urgency for resolution. His political base supports a firm trade stance, and no unified business coalition is pressing for compromise. Canadian officials similarly show no urgency, with Prime Minister Carney downplaying chances of agreements by Trump administration deadlines, stating Canada won't sign arrangements contrary to Canadian interests. The near-term forecast suggests continued border trade volatility, additional Canadian cabinet minister international missions to secure trade agreements, and escalating rhetoric without substantive negotiations. The upcoming USMCA review process could provide a venue for meaningful discussions or potentially deepen the relationship fracture. The medium-term scenario presents more concerning possibilities. If Canada successfully implements its trade diversification strategy, signing major agreements with India, expanding EU arrangements, and deepening Asia-Pacific ties, the fundamental leverage equation changes. American industries currently assume Canada lacks alternatives to U.S. markets. This assumption may prove increasingly invalid. Bank of Canada analysis warns that ongoing trade conflict is fundamentally reshaping Canada's economy, with lasting negative impacts on economic activity. However, lasting impact doesn't necessarily mean permanent U.S. dependency. It may indicate permanent restructuring away from American markets. Legal implications center on the upcoming USMCA review. If tariffs persist and relationships continue deteriorating, Canada could pursue major revisions or potentially threaten withdrawal, creating North American trade chaos unprecedented in recent decades. Key takeaways. 3 critical points merit emphasis. First, Canada is executing a deliberate, well-resourced trade diversification strategy that has already redirected 25 to 30% of traditionally U.S.-bound exports toward European and Asian markets. Second, American industries spanning tourism, manufacturing, and energy are experiencing measurable economic impacts, with billions in lost revenue and thousands of jobs at risk. Third, the structural changes Canada is implementing, new pipelines, expanded trade agreements, diplomatic reconciliations with China and India, represent permanent infrastructure that won't disappear when political conditions shift in Washington. The fundamental observation: the United States may be overlooking a strategic trade realignment that could substantially weaken American economic leverage in North America for a generation. The most consequential economic shifts often aren't those that occur suddenly. They're the ones that reshape landscapes so gradually that damage becomes irreversible before recognition occurs.